Gold just jumped over $100 in a single week. Silver exploded higher by nearly 9%, and while every other channel is talking about the jobs report that triggered this move, there's a second story hiding underneath it. A story almost nobody is covering. A story that could matter far more than the headline everyone's repeating right now. Stick with me for the next 20 minutes, because by the end of this video, you'll understand exactly what most investors are missing this weekend. Welcome back to Silver and Gold Watch. It's Sunday, and that means it's time to break down exactly what happened this week and exactly what it means heading into Monday's open. This was not a quiet week for precious metals. This was one of the strongest weeks of the entire year. Let's walk through it together. Gold climbed roughly 6.5% this week. It pushed above $4,300 an ounce. That's its strongest weekly performance since January. Silver did even better. It surged more than 11%. It broke above $64 an ounce, marking its best weekly showing since February. When you see numbers like that, you know something significant just happened underneath the surface. So let's start with the obvious trigger, because you need to understand this piece before we get to the part everyone's missing. On Friday morning, the Bureau of Labor Statistics dropped a jobs report that stunned traders. The United States economy actually lost jobs in July. Non-farm payrolls fell by 23,000. Economists were expecting a gain of around 80,000. That's not a small miss. That's a massive miss. And it gets worse when you look at the details. The government also revised previous months lower. May and June job numbers were cut significantly. Once you factor in those revisions, the trailing 12-month average for job creation has collapsed to somewhere around 34,000 jobs per month. That's a dramatic slowdown from what analysts believed just a few months ago. This wasn't a single bad month against an otherwise strong trend. The trend itself was already weaker than officially reported. July simply confirmed it. The market's reaction was immediate. The US dollar index dropped to its lowest level in 2 weeks. Treasury yields fell sharply, and traders began unwinding their bets on another Federal Reserve interest rate hike. When the labor market shows this kind of cracking, it becomes much harder for the central bank to justify tightening policy further. That shift alone was enough to send gold and silver sharply higher heading into the weekend. There was a second piece of good news for metals this week as well. Negotiations around partially reopening the Strait of Hormuz have been progressing. For those unfamiliar, that narrow waterway handles a massive share of the world's oil shipments. Any sign of easing tension there tends to bring energy prices down. Lower energy costs typically translate into lower inflation pressure across the broader economy, and lower inflation pressure gives the Federal Reserve even less reason to raise rates. Between the weak jobs data and the easing energy story, you had two major forces pushing in the exact same direction at the exact same time. Now here's where most coverage of this week stopped. Weak jobs report, falling dollar, rate hike bets unwinding, gold and silver rally, story over. Except that's not actually the full story. Because earlier in the week, something else happened that barely made headlines anywhere. And once you understand it, the entire picture around this rally starts to look very different. Last week, the World Gold Council published its regular market update. Buried inside that report, beneath the usual commentary about rate decisions, was a disclosure that deserves far more attention than it received. The United States and Japan conducted a coordinated foreign exchange intervention. This was their first coordinated intervention of this kind in decades. Officially, the stated goal was to counter what officials called disorderly movements in the yen. That's the version most outlets reported. But there's a deeper layer here that almost nobody talked about. According to the analysis inside that same report, the real concern may not have simply been yen weakness itself. It may have been something bigger. Japan happens to be the largest foreign holder of United States Treasury bonds on Earth. When a currency weakens as sharply as the yen has been weakening, a central bank sometimes responds by selling foreign assets to defend its own currency. If Japan had begun selling large amounts of U.S. treasuries to prop up the yen, that would send shockwaves through global bond markets. It would push U.S. borrowing costs higher at a moment when the American economy is already showing cracks. The coordinated intervention may have been less about protecting the yen and more about preventing Japan from being forced into a position where it needed to dump U.S. debt. That distinction might sound small. It is not small. It's actually one of the most important signals in this entire market right now. Think about what it means when two of the largest economies on Earth feel the need to step in together to manage a currency and debt relationship this delicate. It tells you that beneath the surface of calm daily headlines, there are real structural strains building inside the global financial system. And history has shown again and again that whenever confidence in currency stability or sovereign debt begins to wobble even slightly, investors instinctively rotate toward assets that don't depend on any single government's promises. Gold has filled that role for centuries. Increasingly, silver is stepping into a similar role as well. This is the hidden signal that connects everything we saw this week. The weak jobs report gave gold and silver their headline catalyst. But the currency intervention story tells you something deeper about why institutional money may be building longer-term positioning in these metals, regardless of what any single jobs report says on any single Friday. Let's bring the gold to silver ratio into this conversation because it's telling its own important story right now. Just over a week ago, that ratio was sitting near 69. By Friday, it had compressed down toward the mid-60 range. When that ratio falls this quickly, it usually means silver is outperforming gold by a wide margin, and that's exactly what we saw this week. Silver's percentage gain nearly doubled gold's percentage gain across the same 5 trading days. That kind of outperformance often signals growing conviction among traders that the broader metals rally still has room to run. Let's also talk about where these prices sit relative to their bigger historical picture, because context matters here. Gold is still sitting well below the record highs it touched back in January when it briefly traded near $5,600 an ounce. Silver is also still trading well below the extraordinary peak it touched during that same period earlier this year. In other words, this week's rally, although powerful, is not happening at the top of some unprecedented spike. It's happening after a meaningful pullback from those highs. That context changes how you should think about this move. This isn't chasing a blow off top. This is a strong recovery building off a corrective base. So what should you actually be watching as we head into the new trading week? Watch the currency story closely because coordinated interventions like the one we just discussed rarely happen just once and then disappear quietly. If tension around the yen and U.S. Treasury holdings continues building, that could keep providing underlying support for gold and silver regardless of what any single economic report shows. Watch upcoming inflation data including the Consumer Price Index and Producer Price Index reports scheduled for release this week. Hot inflation numbers could complicate the case for a rate cut even after this week's weak jobs data. Cooler numbers would likely reinforce everything we just saw happen on Friday. Watch initial jobless claims as well, since they'll give the market its next real-time read on whether Friday's weak report was a genuine turning point or a temporary anomaly. Also keep a close eye on the Federal Reserve's tone in the days ahead. Even after a weak jobs report, some officials have continued signaling caution about cutting rates too quickly if inflation doesn't cooperate. That internal tension between a softening labor market and lingering inflation concerns is likely to keep driving volatility in both directions for gold and silver in the near term. Now let's talk about what this actually means for you heading into Monday. If you're already holding gold or silver, this week's move reinforces a broader trend that's been building for months. Falling rate hike expectations, a weakening labor market, structural currency tension between major global powers, central banks continuing to accumulate gold, all of these forces are stacking in a direction that has historically supported precious metals prices over time. That doesn't mean every single week will look like this one. Volatility works in both directions, and pullbacks are a completely normal part of any strong trend. But understanding the deeper forces at play gives you the ability to hold your position with far more confidence than simply reacting to headlines. If you're considering buying for the first time, this week's action offers an important lesson. The biggest moves in these markets often happen quickly and without much warning. Waiting for absolute certainty before making a decision often means missing the exact moments that matter most. That doesn't mean rushing in without understanding the risks. It means staying informed enough to act decisively when the underlying picture supports it. One more thing worth remembering as we close out this week. Markets rarely hand you the full story in a single headline. The jobs report explained the immediate spark behind this rally. But the currency intervention story explains something far more important about the structural pressures building beneath the surface of the entire global financial system. Understanding both pieces together gives you a much clearer picture than focusing on just one. That's exactly why this channel exists, not to chase every headline the moment it breaks, but to help you understand the deeper forces connecting those headlines together so you're never caught off guard by what happens next. If this breakdown helped you understand this week's move a little better, make sure you hit that like button right now. It genuinely helps this channel reach more people who need to see the full picture before Monday's open. If you haven't subscribed yet, now is the perfect time because we'll be covering every twist in this story as it continues developing throughout the week. And I want to hear from you directly. Drop a comment below and tell me this. Do you think this rally has more room to run heading into next week? Or are we due for a pullback after such a strong move? I read every single comment and I'll be responding to as many as I can. Thank you for watching Silver and Gold Watch. Stay sharp, stay informed, and I'll see you in the next video.